Use that to dovetail into our next guest here. Both say that there's maximum noise in the market due to the speculation about a Trump 2.0 administration, but their playbooks for the new year differ just ever so slightly. Joining me now are David Harden, the CEO and Chief Investment Officer over at Summit Global Investments. Also, Jenny Harrington, the CEO and Portfolio Manager over at Gilman Hill Asset Management. She is also, of course, you see her often, a CNBC contributor. Thank you both for being here right now. Jenny, we'll start with you. You just heard Steve's report. I wonder how much of the market action next year, I know it has to be driven in some way, maybe even largely so by the Fed. But how important is it, and is it noise in your mind?
It's noise, and I think that noise ends up creating chaos. So it's funny thinking about coming on and then listening to Steve where he's saying things like there's inflation risk to the upside and uncertain fiscal policy. And I'm thinking, you know, tariffs and who's going to be in the cabinet and massive wars overseas. And when I hear all that, I think chaos. And as an investor, I have a really mixed response to that because on the one hand, it hurts portfolio returns, makes clients very uncomfortable. On the other hand, it creates amazing opportunity. And the best investments I've ever made have come from chaotic time periods. So I'm kind of excited about next year, even though it's with a perverse lens.
You know, it's interesting, David. It doesn't seem like chaos right now, despite some of the recent volatility we've seen in the wake of the last Fed rate decision. Largely, we're still near record highs, and it's been a nice march higher throughout the course of the last year. What exactly is your outlook in 2025, given the fact that we've already seen massive positivity in the markets over the past 12 to 24 months?
Well, I appreciate that, Dom. I can sense Jenny's positive or cautious optimism, and I'm very cautiously optimistic about 2025. The Fed definitely did something last week. You know, it was first, we don't guess, we don't speculate, we don't assume, and now it's, well, we do. And so this fiscal policy, tariff news, there's going to be a lot of, I think, short-term volatility in the first half of 2025, but that's going to create opportunity. And I do see some really great opportunities. Valuations are stretched, but I think we can focus on what I call defensive growers or defensive growth. This is companies that can really defend their higher valuations, if you will. And there's some other things that we can do for 2025 that can make a difference in our portfolios.
David, Jenny, I'm going to have you both hold on for 1 second. We've got some breaking news right now. The 2-year note auction is up and the results are in. Rick Santelli is tracking the action in the bond market from the CME. Rick, over to you.
Yes, and that's why yields are moving a bit lower, Dom. Let's go through it. $69 billion. The first leg of a 3-leg refunding from the Treasury, totaling $183 billion. Tomorrow we'll have 5 years. The day after Christmas, we'll have 7 years. The yield, 4.335. Very close to the when issued market, so it priced pretty good. And if you look at all the metrics, well, they're all close to an average, but there is one anomaly here. The anomaly is we had 82.1 indirects and 6.6 directs. Now, if you add them together, it's 88.7, which is pretty good. But I rarely see these types of splits. And I think it's because of the holidays, for whatever reason, direct bidders, those bidders are insurance companies, pension funds, they laid low. But foreign entities going through primary dealers at 82.1 was a record, and they definitely showed up. Dealers took 11.3% of the auction, Dom. That's less than a 13% 10-auction average. The grade for this auction, demand-wise, B as in boy. And I do think that you're going to continue to see pretty good action for the auctions for the rest of the year, as many, of course, want to buy into the turn at the end of the year. Back to you.
All right, Rick Santelli with the latest action there. Thank you very much. It seems like, again, David and Jenny, dealers did not have to take down as much of the offer than they had to. I mean, they have to bid at these things, but it seems like other investors out there, whether they're direct or indirect bidders, have done it. So I guess maybe, David, I'm going to follow up with you. Is the 2-year note auction, or any bond auction for that matter, noise in your mind?
In some respects, yes. I think that we have to keep our eye on the longer picture and not become too focused on short-term trading and have a little bit of a longer-term approach. But this year, this isn't a landmine economy. We have trade policy problems that we're going to have to work through. We have federal debt that we're going to have to work through. We have geopolitical risks. We have inflation. So this brings in these yields and these auctions. And so there's a lot that we have to shift through this year. But the reality is there's some great opportunities out there.
Jenny,